Hello everyone, we will get started at the top of the hour so that we can keep everybody on track and so that we can hopefully get through the presentation and any questions that you may have. Okay, we're going to go ahead and get started. Hello, everyone, and thank you for joining today. I know this is a very important topic. It is student loan repayment. My name is Deborah Robinson. I'm a member experience leader at Health Action Council, and I'm excited to be hosting this session today. We want to thank all of our annual supporters who help make our webinars possible. Without their support, these webinars would not take place. Before we begin, I want to remind everyone, if you have any questions, please use the Q&A or the chat function located on the Zoom navigation bar. We will be monitoring both and will pause it at the end of the session and respond to your questions. If for some reason you have any technical difficulties, please email us at events@healthactioncouncil.org. This webinar is being recorded and will be available to our Health Action Council members on our website under Member Center section at healthactioncouncil.org. If you've misplaced or forgotten your login information, please let one of our team know and we'll be happy to help you. Today's session has been approved for SHRM, STEVES, and HRCI credit. So we will be having a poll at the end of the webinar. So stay on so our Health Action Council members can receive credit. Let's get into the topic. We know that student loan repayment has been on hold since March of 2020 due to the pandemic. There was a Supreme Court ruling a couple weeks ago about President Biden's proposed plan. And since then, the president has a new plan that has been announced as well. With all of these moving targets and topics, we knew clarification was in order. We have with us today Hannah Actor from Ascendium Education Group. They are a nonprofit organization whose sole purpose is to advise people in higher education regarding loans, to help them create opportunities in higher ed. Hannah has over 20 years of experience in learning and development, team management, and student loan training. At Ascendium, she performs quality assurance, trains customer service staff, and serves as a co-chair of the Corporate Compliance Committee. As a certified financial education instructor, Hannah also counsels student loan borrowers on their repayment options. More recently, she has delivered student loan repayment presentation to numerous organizations, including colleges, universities, nonprofits, professional associations, and state agencies. And with that, we'd like to welcome Hannah. And Hannah, the floor is all yours.
Great, thank you. I often joke when I do these presentations. I left college, I graduated from the University of Wisconsin 20 plus years ago, and I suspected I would be a student loan repayment expert, but not in this way. I was busy paying my own student loans and figured, oh, I'll have this down after a while. So ironic how things ended up. I will share my screen so we can get going. And then this is going to stop your screen sharing. So hopefully that's okay that I take over.
That is all good.
Okay, here we go. So looking at this, looks like screen sharing okay. Everybody should see
Perfect.
the PowerPoint. We will get started. Lots to cover. And as she mentioned, just put, questions you have in the chat, the Q&A, things like that as we move forward. I will answer them. I have built-in breaks for questions, but sometimes we'll just get to them, as we see fit. Okay, so one of the first things I thought we could do is you could put in the chat what are some of the challenges you worry student loan borrowers will be facing now that they're moving into repayment? This helps me make sure I cover certain topics. So if you put in the chat, what are topics that you're worried about when it comes to student loan repayment? See some of that answers already popping up. Affording a payment? Yeah, I think that's high on most people's minds. And the good news is with student loans, there are a lot of options out there, but not every option works for every person. So we'll go over a lot of them. Are the lenders the same? That's a good question. There have been a lot of changes over the last few years while loans were on pause. So I will make sure to get that covered. Seems like that's the most of it, but I think the big one, affording a payment, knowing who has my loans, payment plan restructuring. I can't afford what I originally had signed up for in repayment plans. So yeah, I think that a big part of today's webinar will be talking about how do you change your repayment plan, or how do you find a monthly payment that works better for you? Again, I mentioned when I left school, I really thought there was two options: pay or don't pay. And I found out since then there are so many options available to student loan borrowers, but one of the big issues is a lack of awareness on the options. So as somebody else put, finding the best options. And interest. So yes, interest is back. That hasn't been a thing the last few years, and at least direct loans or federally held loans. And that is going to be something we all have to get used to once again. So let's move forward and dive in. To kind of understand where we're at, let's talk about where we've been. So the COVID-19 emergency relief student loan payment pause was in place on federally direct loans or federally held loans from March 13th of 2020 to August 31st of this year. One thing that's not very well known is this payment pause didn't apply to all student loans. And this has been a big point of confusion for many borrowers. So most student loans were covered by the payment pause if they were federally held, but there are other federal student loans that were more held by private institutions, private servicers, guarantors, lenders, still controlled by the federal system, and they were not put on a payment pause. So you can imagine confusion for those borrowers when all they're doing is seeing on the news their loans are on pause, and they get a call from their student loan servicer saying you owe a payment. Those borrowers, they didn't know who to trust. The news was telling them they didn't know anything, yet they may have indeed owed payments. So the payment pause did exclude FFEL loans, that's Federal Family Education Loan Program loans, as well as Perkins loans, as long as they weren't held by the Department of Education themselves. In some cases, those loans did get transferred to the Department of Education when perhaps a lender stopped servicing loans, things like that, but most of them are still held by private institutions and therefore not included. And then it also excluded private loans in general. So I do think during the pandemic, there were some defaults that happened, not because of a lack of funds, but more of a lack of awareness and not knowing who to trust. So this did not apply to everyone. Then as we got more to recent times, so this pause went in place for a while. I think the first extension happened August of 2020, and that became the first of 9 extensions. So I think for some of us, we started to get skeptical and wonder if student loans ever would indeed go back into repayment. They did. That time is now here. And so in early June, Congress, as part of the debt ceiling agreement, came to an agreement that student loans must go back into repayment, and they had to do so by this fall. So student loan interest is set to start again, starting on September 1st, and then monthly payments will be due again starting in October. Due dates will vary from borrower to borrower. Now that was in early June that we knew this was coming, but I do think some folks still held out hope that the proposed federal debt relief plan the president had for giving $10,000 to $20,000 in student loans would go through and ease some of that burden. We now know that that was struck down by the Supreme Court. It is not going to go through. And there have been several announcements from the Department of Education and the president detailing new programs that will still provide relief. So I will cover all of those programs that are being detailed today so you can get the latest updates. We are still waiting to hear some of the details for some of these things. We know they're coming, but we don't know necessarily when, but I'll go over what we do know and what we don't know. So today's plan, we're going to go over the student loan repayment plans, just understanding all the plans that are out there, how you can get them set up, how they differ from one another. We'll talk about how to postpone payments altogether, because there are times where you may not find a repayment plan that works for you. You may not still be able to afford the payments for the repayment plan that maybe is the best fit for you, so you can postpone payments altogether. I try to limit how often people use those postponement options, however they're out there. We'll talk about the types of forgiveness programs that remain, and we'll look at some case studies so you can actually see some examples of how this works for people in certain situations, and then hopefully apply it to your own or maybe somebody you're working with. And also how to avoid extra costs, because nobody wants to pay more than they have to. So first things first, let's talk about preparing for repayment. For some borrowers, they are preparing for repayment because they are just now leaving school. And for others, maybe they were in repayment and then that payment pause came into effect. So now they're preparing for repayment again. The first step is finding your student loans. So I know one of the questions that came up that is worrying people is what lenders are left. So during the last few years, a number of student loan servicers announced plans to exit the industry. It isn't really as profitable as it used to be. They're getting a lot of negative press. There's lawsuits. So some of these big names decided they no longer want to service student loans. And that meant that these loans had to go elsewhere to new companies. For the most part, they're not new companies. They're just new to that student loan borrower. So there weren't a whole bunch of new servicers that popped up to take on this work. It really fell to the other servicers that remained to take on a larger portfolio. So that's going to cause a little chaos because you have the same company and sometimes the same amount of staff with a lot more student loan borrowers coming over. So for those of you who have student loans, or again, if you're working with somebody who has student loans, it's important to note that the company you had before this payment pause, the company you were making payments to way back when, may not be the company you have today. They probably did send notices. They're supposed to, either via email or mail, but it's easy to turn a blind eye to those notices when you don't have to make payments. So people may not realize their loan actually moved on them. So to find your student loans, that part's a little bit easier. You can go to studentaid.gov, and I have the website here, and I sent Kelly a handout. Hopefully she can distribute to that folks later, just so you don't have to scribble down notes. You just have a copy of this. Studentaid.gov. Really, I'm going to mention a number of times throughout this presentation. It's become a one-stop shop for all of your federal student loan needs, including locating loans. So that would be the first step. That's where I would start. Make sure your loans are where you think they are. And for some people, maybe they have no idea. Find your student loans. Studentaid.gov will have all the federal loans, institutional loans. Private student loans, those aren't federal. They're not going to be at studentaid.gov. So sometimes there isn't enough federal funds left over to cover tuition and all of the expenses. So students have to turn to private loans. To find private loans, annualcreditreport.com, they'll list everything. They'll have the federal loans, they'll have the private loans, but they'll have who the loan holder is. The options I'm going over today are for federal student loans. Things work a little different in the private loan world. Certainly those loans need to be a priority too. I just can't speak to them. I don't know those options. That's not my expertise, but that's how you would find them, as annualcreditreport.com. So first thing, find the student loan. Second, as you're approaching repayment, decide what the goal is. So when I'm counseling student loan borrowers, that's one of the first things I say is, what is your goal? Because it's not going to be the same for everybody. For some people, it's to repay at the lowest overall cost. So I always use my husband and me as an example. My husband, he's an economics major. He wants to make sure he never pays more than he has to. So he's very concerned about interest charges, things like that. He wants to pay the least in the long run. We're kind of opposites. Me, I want to have wiggle room in my budget. So I want the lowest monthly payment possible. I don't care if that means I'm paying more in the long run. I want to go out to dinner when I want to go out to dinner. I want to buy a new sweater when I want to buy a new sweater. The good thing is we balance each other. But I don't know what each student loan borrower wants. Do they want to pay less in the long run, or do they want the lowest payment? You often can't get both. So you have to decide what your priority is. And for others, it might be to qualify for a loan forgiveness option like public service loan forgiveness. Once a person knows their goal, that makes it a lot easier to determine their path to repayment and which plans to choose. So just something to think about, what is the goal? And then as I go through the various repayment plans, you can kind of think of how each one impacts that goal. Also, a great tool, and it's also at studentaid.gov, this loan simulator tool can really give a side-by-side comparison of all of the repayment plans. So a student loan borrower can look and see, okay, this one is going to cost this much per month, but in the long run, I'll save this much money in interest. Or this one, I'm going to have the loan for 20 years, and on this plan, I'll only have it for 10. So again, somebody's goal may be to get rid of the loan as fast as possible. Each repayment plan is going to differ, and some will do just that. So loan simulator tool, I suggest checking it out. Another thing for preparing for repayment. For student loan borrowers who were in school during this pause, they've never had to go into repayment. This is not a familiar territory for them, and they may not understand how the grace period works. For most student loan borrowers, they are given 6 months when they leave school, either because they dropped less than half time or because they graduated. They are given 6 months before they have to start paying on their student loans. There are a couple exceptions I put on the screen where it's a bit longer for different types of federal student loans. One source of confusion is that student loan borrowers only get one grace period. So I know this is long before the pandemic and the payment pause. This has always been a source of confusion. Some student loan borrowers thought they would just keep getting a grace period every time they left school. So maybe they went to school for a couple years, life happened, they dropped out for a little while, used their grace period, came back, graduated. They expected another grace period after graduation and they didn't get it because they'd already used it when they dropped out 2 years ago. So there's only one grace period, and if a borrower uses it, it's done. Now, I get a lot of questions about how this payment pause impacts that grace period because many borrowers left school during the payment pause, a lot of them through the positive aspect of graduating, and thought they were just automatically placed in the payment pause, and maybe their grace period is still sitting there waiting for when the payment pause comes to an end. That is not the case. Grace periods were still used during the payment pause. So for borrowers who left school, they went into their grace period, in most cases for 6 months, then they left their grace period and were placed in the payment pause. This means they won't have a grace period remaining when student loans go back into repayment in October. They'll just start having monthly payments due. So that's just a point of confusion for many borrowers. They need to understand their grace period was already used if they left school during the payment pause. Now, here are all the various repayment plans available. And this is where when I left school, I thought the options were pay or don't pay and face the consequences. And really, I had no clue that I could change my monthly payment and find something more suitable. Luckily, I started working at a student loan company while I was still in my grace period. So I learned that quick and I was able to shift to a repayment plan I could afford. And so hopefully we can do that for other folks today. So I have grouped these repayment plans into 2 groups, non-income based, which may work better for borrowers who have higher incomes because the higher your income, the higher your monthly payment would be under an income-driven plan. And then we have the income-driven ones. Those ones are really tailored to fit the borrower's situation. They take income and family size into consideration and find a monthly payment that fits them specifically. So we'll look at all of them. The first one we have is standard repayment. And this is the one borrowers are automatically placed on when they leave school. It's a 10-year plan and the monthly payment never changes. And after 10 years, the loan becomes paid off. This can be the best plan for someone who wants to pay or get rid of their loan the fastest, or who wants to pay the least in the long run when it comes to interest. It tends to save borrowers the most money in interest because they pay the loan off sooner, and it's great, but it does cause a lot of borrowers to suffer from sticker shock because they get that first monthly payment. It's only a 10-year plan, and depending on the size of their student loan debt, that first monthly payment could be high, and that's where some borrowers are like, oh, I don't know what to do. If you're in that boat or you know somebody in that boat, that's where you have to start exploring the other payment plans. But this is the one everybody's placed in to begin with. And then the other non-income based repayment plans I have here in just one slide, they all differ a little bit. The first one is graduated repayment. And for this one, the monthly payment gradually increases every 2 years. So a person starts out small, and then a couple years later, their payment will just grow a little bit, and it grows a little bit, and it grows a little bit, and they still get it paid off in 10 years. So this still works well for somebody who wants to get rid of their loan quickly. It doesn't work as well for somebody who wants to pay the least in the long run because it will end up costing more money in interest. It's a fine plan, but I have concerns with this plan. And my concern with this plan is student loan borrowers need to be prepared for something to be changing to know they can afford a higher monthly payment in 2 years, and another one in 4 years, and another one in 6 years. I think we saw this as a problem with the housing crisis back in the late 2000s. People had these mortgages where their monthly payments would increase, and then all of a sudden they realized they couldn't afford the monthly payment anymore. Graduated repayment could be like that. So if a person's entering into this repayment plan, they need to have a plan themselves for what's going to happen in 2 years, 4 years, 6 years when their monthly payments increase. It could be that they know they're in like an internship or residency and they'll get paid more down the road, or it could be they have some plan to pay off some other debt first, but just they need to have a plan to go into a graduated repayment plan. The next one's extended repayment. This is the one I used because when I left school, there weren't a lot of income-driven repayment options out there. And I knew the monthly payment I had was going to be tight. It was going to be hard to put it into my budget and still enjoy the other things I wanted to enjoy. So I went into an extended repayment plan that gave me 20 years to pay back my student loan instead of 10. And it nearly cut my payment in half. It did mean I was going to pay more interest in the long run. But that was okay to me because the other thing to understand in the student loan industry is there are no prepayment penalties. A person can always pay more than their minimum monthly payment. So that was exactly my plan. I would take that smaller monthly payment, so that's all I was committed to, and then I would pay extra the months I could to try to get rid of the loan faster and knock away some of that interest. So extended repayment, though, if your goal is to get rid of the loan the fastest, that's not good because you're going to have the loan for longer, but it does typically give a person a more affordable payment. And then the last one is extended graduated repayment. And you can probably guess this is a combination of the two that came before it. So student loan borrowers will get their loans for longer, and also their payments will gradually increase. So it may start out very small, but then get larger over time. And I happened to see the question pop in here in the chat. What are the repayment options for the Parent Plus loans? So far, all of these options I've went over are available for Parent Plus loans. I will call out when they're not. So standard repayment, the one on the previous slide, works for Parent Plus loans, and then all of these work for Parent Plus loans as well. Something to keep in mind with these non-income based repayment plans, the extended plans do require a minimum loan balance. So to enter into an extended repayment plan, student loan borrowers have to have at least $30,000 in either the direct loan program or the FEL program. Just one thing to note, the FEL program came to an end in 2010. So if your student loans or whoever you're working with student loans were taken out after 2010, they're likely just direct loan borrowers. But it's $30,000 in one of those programs, not both. So they're not going to consider a combination, just what you have in that specific program. So that one won't work for everybody who have lower student loan balances, but for folks who have higher student loan balances above 30,000, extended works just fine. Another thing that I've mentioned a couple times now is it will cost more money in interest to do something other than standard. So that's just something borrowers need to keep in mind. And if they use the loan simulator tool at studentaid.gov, it'll tell them exactly how much that interest will be. Moving on to the income-driven repayment plans. And these do get trickier for Parent Plus borrowers, so I will call out the only one that does work for Parent Plus borrowers. So for most of the income-driven repayment plans, unfortunately, they exclude Parent Plus borrowers. All other student loan borrowers can do them depending on which plan it is and which program they're in, but Parent Plus borrowers, it does get trickier. There is one that works, and I will call that out when I get to it. So for income-driven repayment plans, it allows a monthly payment to be set based on income and family size, like I mentioned before. Some of them require student loan borrowers to have a partial financial hardship, which I refer to as a PFH. It means they just have to hit certain criteria to get into the program. So if a student loan borrower is told they do not qualify for one of the IDR plans, that could be why. They aren't in a partial financial hardship. The good news is there are plans under the IDR umbrella that do not require a partial financial hardship. So if they really want an IDR plan, they just move to a different one. And then for all of these, it sets the monthly payment based on the situation. So for some student loan borrowers, that monthly payment could end up quite low. And therefore, they may get to 20 years down the road and still have a loan left. For all of these, there is a point in time, a cutoff line, where if they still have student loan debt left, it'll just be forgiven because they've been in repayment for long enough. The payments for IDR here count towards public service loan forgiveness. So we'll get into public service loan forgiveness in a little bit. And for IDR, borrowers must reapply each year. So they get into the program and then each year they have to renew their income information. To apply for it, it's at studentaid.gov again. So they go to studentaid.gov, they fill out their information. They can either provide income documentation separately or check something to say it's okay to retrieve it from the IRS. And then the monthly payment gets set from there. So studentaid.gov, like I said, one-stop shop. You can do everything there. The first IDR plan is income-based repayment, and this is available for both direct and FEL loan borrowers. And it's noteworthy here because it's the only IDR plan that is available for FEL loan borrowers. So if somebody has a FEL loan, then this is the one they want to look into, or they would want to consolidate into the direct loan program to do one of the other IDR plans. It does require a partial financial hardship, so people can make too much money to get into this plan. And the repayment period is set at 20 or 25 years. So if they have loan debt remaining at one of those cutoffs, it's based on when they took out their loan. then the rest of the amount does get forgiven. It's hard to say whether or not that will be taxable. Right now, they have a provision in place saying student loan forgiveness can't be taxed at the federal level until 2025. I'm not sure what will happen after 2025. That'll be up to Congress. There's pay as you earn, and this one's only available for direct loan borrowers, which when it comes to federal student loans, most of the portfolio is direct loan borrowers. It does exclude Parent Plus loans and even consolidation loans that paid off Parent Plus loans. And there is a new borrower criteria that must be met. And I think that's, they have to have all their student loans taken out after 2007 and at least one of those after 2011. It does require a partial financial hardship and the repayment period set at 20 years. Nice thing here, IBR can set the monthly payment at 10 to 15% of discretionary income. Pay as you earn is definitely 10%. So chances are somebody may see a smaller payment in pay as you earn. Revised pay as you earn, they just took the pay plan and made slight tweaks to it to make the repay plan. Direct loans only, again, excludes Parent Plus loans, but this one does not have a partial financial hardship required. So a borrower who's told they make too much money for one of the other plans can still get in this plan. It may not make sense because the more money a person makes, the higher their monthly payment will be. But as we move into public service loan forgiveness, you'll find it requires them to be an IDR plan. So some borrowers seeking public service loan forgiveness may select this plan because it might be the only one available to them. For all the other IDR plans, a spouse's income is not taken into consideration if they file their taxes married but separate. If they file them jointly, they are taken into consideration. For repay, they said they don't care how spouses file their taxes. The spouse's income is always taken into consideration. Monthly payments are capped at 10% of discretionary income, and the forgiveness threshold is based on if they have graduate loans or undergrad only loans. So they'll forgive the loan after 20 years for a borrower who has only undergrad loans and 25 years for borrowers with graduate loans. I think they decided graduate students tend to carry higher debt loads and usually have higher incomes. And then I see a question popped up, will the repay loan automatically move to save? Yes, which I think is a great segue for us to talk about save. So saving on a valuable education, SAVE. This is the newest plan. So the Supreme Court struck down President Biden's debt relief plan on June 30th. And also on June 30th, the Department of Education announced the new SAVE plan. So some aspects of SAVE are being implemented right away this summer, and others they're going to be waiting until 2024. But here are some of the details. And yes, this person who put in there will repay, just move to SAVE. That is the case. So for a person who wants to do SAVE, they can enter into repay now, and it'll just automatically transition to SAVE when SAVE is ready to go. Repay will eventually go away and be replaced by SAVE. So for SAVE, monthly payments are going to be capped at 5% of discretionary income for some borrowers, which is the lowest we've seen under the IDR plans, and 10% for others. And again, they're looking at this graduate versus undergraduate cutoff. And the repayment period could be as low as 10 years for some borrowers. And that's going to be based on loan balance. And it'll be balances of $12,000 or less could be eligible for the 10-year mark. They'll add an extra an extra year for every $1,000 a person has in debt. But then the cutoff is 20 years for some borrowers and 25 for others. And one of the better things about SAVE is the government's going to forgive any interest the monthly payment doesn't cover. So a flaw with all these other IDR plans is that the monthly payment may not cover interest. And so that interest just keeps, accumulating and not being paid. With the SAVE plan, if their monthly payment doesn't cover the interest, that's okay. It'll forgive the remaining interest. Trying to think if there's any other aspects of the SAVE plan I want to go over. A lot of them aren't coming yet, but I think that's the gist of it's on the screen. Oh, there was one other thing. I knew I had something there. They also changed the threshold for how they calculate discretionary income. So if a borrower ends up with paying 10% of their discretionary income on the SAVE plan, and if you remember the pay plan was also 10% of discretionary income, they'll still end up with a lower monthly payment on the SAVE plan than they would the pay, because they're changing how they look at that discretionary income. So borrowers will end up with lower monthly payments, a lot of times a shorter window until their loan's paid off, and less interest. This is the most borrower-friendly IDR plan we have seen yet, and it is being implemented as we speak. Again, some portions this summer, others will be next year. I'm excited about this one, you can probably tell. The last one, and I keep this one in here just for our Parent Plus borrowers. So this is the only one that Parent Plus loans can do, but in order to do it, they have to consolidate first. So income contingent repayment is the oldest of all the IDR plans. It's been around since the early 90s. The calculations to determine the monthly payment are different than all the others, but ends up being about 20% of discretionary income. So typically a little higher payment than you're going to see in the other IDR plans. And really, I don't think there's a lot of reasons why student loan borrowers would seek ICR, except for Parent Plus loans, since they can't do any of the others. So for a Parent Plus borrower, they first have to consolidate, and then they can apply for this plan. It does have a repayment period of 25 years. And something to keep in mind is when SAVE goes into place, they plan on, SAVE will replace repay. So you'll see repay go away. They also plan on sunsetting pay as you earn will also go away, but just stay around for borrowers who are in it before it went away. So they will grandfather borrowers in. They are planning on eliminating the ICR plan as well, but they will keep it around only for those Parent Plus borrowers. So this one's sort of going away, but not in the cases of a consolidated loan that paid off a Parent Plus loan. They know this is the only option there, and so they're not completely going to eliminate it. That brings us to consolidation. So as I mentioned, Parent Plus borrowers will have to consolidate to do that ICR plan. And anybody who's interested in consolidation or wants to know what it is, with consolidation, you're really taking out one loan to pay off all of your other student loans. So it's like refinancing. And the new loan will get a new set of terms and generally a new monthly payment. It often is a lower monthly payment because they give borrowers a longer period of time to pay back the loan. I'm often asked if a person can get better interest rates by consolidating, and sadly the answer is no, not really. They lock in the weighted average of your current interest rates, and so a person ends up with an interest rate very similar to what they already had. Unfortunately, in the student loan industry, there's not really a better way to, or a way to get better interest rates. You just kind of get what you have, and the interest rates are based on the year you took out your loan. To apply for consolidation, it's studentaid.gov again. So a person can fill out their consolidation application right there. Things to keep in mind is on the new consolidated loan, you may not have all the same options you had in the old loan. You will have most of them. But Perkins loans, as you can see here, they could lose some interest subsidies if they move into consolidation. For FFEL loans, they often have lender incentives. So if you chose this bank to give you your FFEL loan, they might say you get a 1% discount after so many on-time payments, things like that. Those incentives could be lost if a consolidation happens on a FFEL loan. But the repayment options are the same. So I'm going to go over deferments and forbearances a little bit. The IDR plans are all there. So a lot of the repayment options are the same, but there are some things that could be lost. And at studentaid.gov, there's a full list and things to consider when you're moving into consolidation. I'm going to move to talking about postponed payments. I've been watching the chat and I've just been answering questions as we go. So if anybody wants to pop anything into the chat right now, just because I'm moving past income-driven repayment plans and the various repayment plans, put it in the chat. I'll answer the questions. Otherwise, I'll move to postponing payment and just kind of monitor the chat to see how questions are going. But as we move to postponing payments, the idea here is you may enter into the repayment plan you think suits you best, and you may find the lowest IDR payment and still cannot afford it for some other reason, perhaps a car breaking down and you have to pay those expenses or an unexpected medical bill. There is the option to postpone payments altogether. For those options, deferments and forbearances really are the main ways to postpone payments. A deferment you have to qualify for, so you have to meet certain criteria. But if a student loan borrower qualifies for deferment, it's an entitlement. They fill out paperwork and it's automatically placed in their account. The most common, most popular deferment that everybody's familiar with is the in-school deferment. So while student loan borrowers are in school, as long as they're going at least half time at an accredited school, they can place their loans on hold while going to school. But there are deferments that are for other options. And again, if a person qualifies, they're entitled to the deferment, it'll be placed on the account and they don't have to make monthly payments at that time. For unsubsidized loans, the interest will still accrue during a deferment. But for subsidized loans, the government will pay it. So that's kind of a perk behind a deferment. Forbearances are easier to get. Typically, there aren't the qualifiers. So there's not the criteria a person needs to meet. There's a limited amount of forbearance time a student loan borrower can get throughout the life of their loan. In most cases, it's 36 months. For forbearances, the government never helps out with interest though. So a borrower doesn't want to put too many forbearances on their account because they could see a lot of collecting interest. And forbearances are typically granted in 12-month intervals, but you could ask for a 3-month forbearance or a 5-month forbearance. It doesn't have to be 12 months, but they'll do up to 12 months at a time. And I did see a question pop up. Can we get a copy of this presentation? I'm pretty sure there is a way to do that. I will defer to your administrators who brought me here, but I gave them a handout copy of this so they can pass it along.
And it will be on the member site for our Health Action Council members, probably after Monday.
Sounds good. Thank you. So for forbearances, again, there's not really a lot of criteria to meet. You just have to call into the student loan servicer and say, I need to postpone payments. I think I need a forbearance. They'll ask questions to determine if that's the best option, but it's an easy thing to do. Deferment, same idea. They'll ask questions to determine if that's the best option. However, a person may need to prove their situation to get a deferment, like they might have to send in income information or something like that. But again, the government helps out with interest a little more for deferments. So in my mind, deferments can be slightly better than forbearances. Some deferments have no time limits. So for instance, a person can be in school for as long as they want. There's really no time limit to the in-school deferment. So we always hear about those professional students. The in-school deferment works just fine. Others, like the unemployment deferment, throughout the life of a loan, only get 36 months. And typically these will last 6 months or 12 months, depending on the type of deferment. And then a person has to reapply. And it isn't your job to figure out which deferment's best for the situation. That's the student loan servicer's job. So a person just has to call in and say they're struggling to make their monthly payment. The servicer will ask them a series of questions to find the right payment for them, or excuse me, the right deferment or the right option for them. Ideally, they start with IDR to make sure an income-driven repayment plan isn't better, but then they'll move to deferments and forbearances. Some drawbacks. Interest accrues. So interest will accrue during periods of deferment on unsubsidized loans, as I mentioned, and plus loans, and always during a period of forbearance, not just the unsubsidized portions. And interest will capitalize at the end of the deferment or forbearance, depending on the loan program. So capitalization has been a big concern in the past, and that's when all that unpaid interest actually gets added to the principal balance, and now the loan grows. And you can essentially, you're collecting interest on your interest when capitalization happens. Well, just this summer, they've made a change with interest capitalization and said there's certain times on a student loan where they're no longer going to allow for it. But that change is only in the direct loan world, meaning it won't impact Perkins loans, it won't impact FFEL loans. They can still see capitalization after deferments and forbearances. For direct loans, there will be no interest capitalization after forbearances anymore. There still will be on unsubsidized loans for deferments. So that's one way of forbearance actually could be slightly better than a deferment. However, all that interest still accumulates during a forbearance. The borrower will be responsible for paying it. It just doesn't capitalize and become part of the loan. It will keep the cost down, not having that in place. So that's a positive change coming this summer. As I mentioned, most deferments and forbearances have time limits, so a person needs to use them sparingly, so they always have something to fall back on. And except for repay and save, interest no longer gets paid on the subsidized portions when in deferment after the first 3 years. It's just how their interest subsidies are written. But when it comes to save, again, this is going to be the best plan for most borrowers. They don't have to worry about that. They will have their interest subsidies with deferments going forward. Now there's loan forgiveness programs. Probably the best option if a person qualifies for it is loan forgiveness, just to have their loan wiped out altogether. For the most part, there aren't really quick and easy loan forgiveness options. A person has to work towards them, but they're still there. So the more common ones are on the screen. There are others. So we see public service loan forgiveness, teacher loan forgiveness, income-driven repayment plans. Income-driven repayment plans aren't exactly loan forgiveness, but I put them here because the way it is currently, after a student loan borrower pays, they will see the rest of their debt forgiven after 20 or 25 years if it's remaining. And it's going to be 10 years when SAVE is fully implemented. But public service loan forgiveness and teacher loan forgiveness are your more typical loan forgiveness programs, and they're based on a person's career. Teachers can often do both. They could do teacher loan forgiveness or public service loan forgiveness, but not for the same period of employment. So they have to decide which one seems better. And there's a limit to how much can be forgiven for teachers. Most teachers are only going to qualify for $5,000. Some will qualify for $17,500. And again, the particulars could be at studentaid.gov of who that is. For most borrowers, it's quicker. You could 5 years, you see loan forgiveness, but I think for most borrowers, if they have a higher debt load, it's still worth going the 10 years to have everything wiped out at the end, assuming everything's going to be more than 5,000 or 17,500. And I did see another question pop up. Is there a limit on how many forbearances over the life of the loan? If I had one pre-COVID, would I be eligible again? Probably. There is a limit. The limit's 36 months, depending on the type of loan, but usually it's 36 months, which is 3 years. So if you use one prior to the pandemic, you probably didn't use 36 months worth and you still have forbearance time left. That's one of those, use it sparingly so you have it like that rainy day forbearance, but 36 months is still pretty generous. It's like 3 years of forbearance time. My recommendation is if you use a forbearance, make small payments to help out with that interest during the forbearance just to keep it down. Okay, moving on to loan forgiveness. I'm going to spend more time on public service loan forgiveness because the way it stands today, 1 in 4 Americans work for a qualifying employer for public service loan forgiveness. So it covers a lot of people, and I'll spend more time on it. I'm not going to spend time for the teacher loan forgiveness. And again, if you're working with a teacher or are a teacher, studentaid.gov has everything you need. So for public service loan forgiveness, it's for borrowers who work full-time for public service employers, and then they're eligible to have the remaining balance of their direct loans forgiven after 120 qualifying payments that were made after October 1st, 2007. So this program originated in 2007, and only payments made after 2007 count. And it does require 10 years worth of payments. So this isn't a quick, easy fix. But in some cases, borrowers hear about it after they've already worked for a qualifying employer for 6-7 years. And so, they're already halfway there, if not more. Also, something to note is this payment pause. The months we spent in the suspension counted as qualifying payments. So for borrowers who worked for a qualifying employer since 2020, in the end, they're going to have like about 40 months of qualifying payments under their belt where they really didn't have to pay. The qualifying employers are the government. Any level of government counts as a qualifying employer. That's a public service, and the government's one of our largest employers. So that's, again, how so many Americans qualify. Not-for-profits that file as a 501c3, meaning they're tax exempt under the IRS code, also qualify. And then AmeriCorps or Peace Corps positions are considered public service as well. I see a question popped up. Since the SAVE program is just starting, will people get credit for years already paid towards the 10-year repayment period? That one's hard for me to say. I believe so. So if it's just for SAVE itself and then they get to year 10, how they're going to factor that in, like if they were on standard or if they were on another IDR plan, it's just, I don't know all the particulars for that one yet. I think that's going to be how it works, but I'm waiting for all the details. Now, the same question for PSLF for the 10 years. So if a person was on any of the IDR plans, it doesn't have to be SAVE. They'll look at all the 10 years, combining all the plans they were on. But I'm going to talk about qualifying payments for PSLF here shortly. Now, for this list of qualifying employers, there's a small difference. It says private not-for-profit, which the other one had not-for-profits as well. But this group does not have to be tax exempt as long as the employer is offering one of the services listed. And it's quite the list. So you have emergency management, military service, public safety, law enforcement, public interest law services, early childhood education, public service for individuals with disabilities and the elderly, public health, public education, public library services, school library or other school-based services. I mean, it's a huge list. So it can be a nonprofit that's not a 501c3. They're not tax exempt. They still need to be a nonprofit, but as long as they offer one of these services. So something also to keep in mind for public service loan forgiveness, it isn't about the career the borrower has. It's about the employer and what the employer does. So the borrower themselves could be a janitor at one of these institutions. They don't have to be in public health themselves as long as the institution they're working for is in public health. But to really emphasize why it's about, like, just to kind of drive home, it's about the employer and not about the borrower, I use pharmacist as an example. So if you have a pharmacist working for, I'm going to throw out Walgreens because I'm very familiar with Walgreens. They're my pharmacy. I suspect Walgreens is a for-profit institution. Pharmacists fall under public health, but if they're working for a for-profit institution, they're not going to qualify for public service loan forgiveness. A pharmacist doing the exact same job at a VA hospital, that's more government run, is going to qualify for public service loan forgiveness. So it's not about the job, it's about who you work for. Now, I only hope that maybe a pharmacist working for a for-profit institution is getting paid more than a pharmacist working for a public institution, but I don't know that's the case. I tell students when I'm working with them, just research your future employers so you know, am I going to get a higher salary that makes it okay I'm not eligible for public service loan forgiveness? Or would I rather work for an employer that makes me eligible for public service loan forgiveness? These are decisions they have to make. Now, for qualifying payments, one of the biggest points of confusion for this program and why it had so many rejections in the beginning, it had a high rejection rate, was borrowers were not aware they had to be on certain repayment plans. Only the repayment plans listed on the screen qualify for public service loan forgiveness. Right now, there are account adjustments going on, waivers, things like that. They're kind of eliminating some of this, or they're waiving it for the time being, but it will go back to this. So for borrowers who are pursuing PSLF, if they know that they want to do this, they need to switch to one of these plans. And it's mostly IDR plans with the exception of the standard plan at the bottom. And a person can't stay on the standard plan and do public service loan forgiveness because if they stayed on the standard plan, they'd pay the loan back on their own before they got to year 10. They keep this one in as a qualifying payment because all borrowers start on the standard plan and they want those first few payments they make to count. But once somebody knows they want to do PSLF, they need to switch to one of the IDR plans. And somebody else just popped in the chat, how do you know how many payments you have made? Once you've applied for PSLF and your application's processed, you'll move to a servicer, which I think I'm coming up on another slide, and they will let the student loan borrowers know how many qualifying payments they have. Let me move and see if that's the next slide. It is. Okay, so borrowers considering public service loan forgiveness, they apply at studentaid.gov. You probably could have guessed that by now. And then MOHELA is the new student loan servicer to handle PSLF. So Fed Loan Servicing used to be the old servicer that did all PSLF processing, but they were one of the big servicers to announce they no longer plan to service federal student loans. So their portfolio, all of their PSLF portfolio, I should say, shifted to MOHELA, and MOHELA now does all of that. So for a student loan borrower doing PSLF, they first apply. They might have to wait several months for their application to be processed. PSLF has had a lot of press and a lot of people applying for it this last year, especially because of some of the waivers. Therefore, processing is taking a long time. Just know that's a normal thing. They'll wait for a while for it to get processed. Once it's processed and approved, the student loan automatically transfers to MOHELA if the borrower wasn't already serviced by MOHELA. Once they're at MOHELA, MOHELA will update them on their payment count. They can just look at this on the website. They'll log in and see you have so many qualifying payments. And the qualifying payments only get updated every time somebody submits an application. So it's recommended to apply annually. A common mistake people made with PSLF is they thought they needed to wait till year 10 to apply. They do not need to wait to year 10. It's actually better to apply each year. So each year you can see that payment count advance. Year 1, okay, I have 12 qualifying payments. Year 2, I have 24 qualifying payments. And if you send in that application, you see it was processed and the qualifying payments, it doesn't jump, something went wrong. And then a student loan borrower knows to call into MOHELA and find out what happened. Why did my payment count not advance? And this way, if they're in the wrong repayment plan, they can quickly fix it and switch to the correct one. And I have another question that popped up. Will MOHELA know how to apply the 40 months you mentioned while loans were on hold? Yes. So the 40 months I mentioned for the payment suspension, MOHELA does know that those count. Certainly there's errors in processing, but if you document that you worked for a qualifying employer for those 40 months, then they need to make sure that that matches. They should not be looking for payments being made during the payment pause. And then any specific questions for MOHELA or somebody who's on PSLF that wants to know something about their status, I did put the number down here. You could also Google it. It's just MOHELA's PSLF hotline. So choosing the right repayment plan. Sometimes it just helps to look at people and how this impacts them to kind of get a fit for how it would impact you or somebody you know. So I put in little case studies. We have Oliver. Oliver makes $65,000 a year and he has $78,000 in federal student loan debt. This is how his options look for him today. I don't have the save plan in here yet because it's not official yet. So if he did the standard plan, he'd pay $810 a month. For most people, that's probably not something they can afford. I mean, it's going to be difficult to get that in the budget. You can see when it comes to total interest paid, this would be cheaper. But this is where when I talk about maybe I want a payment I can afford that I don't stress out about and I'm okay paying more in the long run, this might be one of those situations. So if he did one of the income-driven repayment plans, he'd start out at $372. It's a range because the calculators at studentaid.gov and their loan simulator tool, they assume that student loan borrowers are going to see salary increases every year. And actually, it's a pretty generous assumption. I think they assume 5% of an increase every year. but that's why there's a range here. Also, the range reflects, usually when you enter into an income-driven repayment plan, there's a cap on how high your monthly payment could ever be. And so it also reflects that cap. That's where you see the 810 here under pay as you earn, because that's the highest that he would have paid under standard. Repay doesn't have the same cap. But Oliver has to decide what he prefers. You know, if he wanted to pay less interest in the long run, maybe standard, and he finds a way to make it work. If not, he might want to move to one of the income-driven repayment plans. There is no loan forgiveness for Oliver because he's projected to pay the student loan back on his own under one of the income-driven repayment plans. We have Vanessa. I work Vanessa in because every year I give a presentation to a group of psychology students. They're interns working towards their doctorate. They have a lot of student loan debt. So they may have high incomes, but significant student loan debt. So I think for some people, this represents them, and I want to make sure that I cover that group as well. With that much student loan debt, it's possible she has multiple student loans at multiple places. So it may be a good idea for Vanessa to consolidate to get all her student loans in one place. Her standard payment costs more than a lot of people's house payment. And her income's high, but that's still a high monthly payment. Extended fixed drops at some, but look at how much interest she would pay if she did extended fixed. She'd have the loan for 25 years and pay a lot in interest. Income-driven repayment plans do seem like a better option. You can see the monthly payment down here. She'd start out at $730. Again, there's the assumption that she'd see salary increases over time, but she does look like she would have loan forgiveness available to her when she gets to year 20 or 25. Lastly, we have Trent. Trent has a $32,000 income, $50,000 a year, or excuse me, $32,000 a year, $50,000 of student loan debt. I think he's more typical when we see undergrad students just leaving college. His standard payment's $519. Again, he'd pay not as much in interest as the standard plan, or excuse me, as the extended plan if he stayed on standard. However, the income-driven repayment plan still may end up better for Trent. He starts out pretty low, and he could see loan forgiveness if his situation doesn't greatly change. I saw another question pop up, so let's see. Oh, I think that one's already answered, so. Okay, sorry, that was the last one, I already answered it. As we wind down here, how to avoid extra costs or things to consider. The interest subsidies are different for all of the income-driven repayment plans. ICR is the most expensive. IBR and pay-as-you-earn, they're helpful, especially for the first 3 years, but then after that, borrowers are on their own with remaining interest. Until Save, Repay was the best one when it came to interest subsidies because throughout the whole term, the government at least helped to some degree with the interest. But then I mentioned Save, the government's going to help out with whatever the monthly payment doesn't cover. So when it comes to interest, Save is going to be your best IDR plan. And then I mentioned capitalization. That's certainly something to be aware of. And they really are eliminating when it did occur for direct loans. FEL loans, Perkins loans, some of those other loan programs that are a bit older, capitalization will still occur as it always once did when they enter repayment, when they consolidate, when they default, when they enter or exit periods of deferment or forbearance. But for direct loans going forward, it's really going to just be the cases on the screen. When unsubsidized loans exit deferment, and when borrowers no longer have a PFH on an IBR or they leave IBR. They really aren't going to see capitalization anymore in any of the other IDR plans. So this is a positive change. And for the unsubsidized loans going on deferment, if they make small interest payments during the deferment, they can eliminate that capitalization or at least minimize it. See another thing popped up in the chat. Somebody's just venting about how high some of those payments were in the case studies, and absolutely. Really, I feel like sometimes in that entrance counseling, when people are taking out student loans, they should look at those case studies to really have a handle on how much debt they're taking out and what impact it could have, because it can be some pretty high monthly payments. But dangers of default. The one thing to avoid for sure is default. You do not want to default on a federal student loan. The consequences are on the screen. Right now, because of the pandemic, these consequences are on hold, are not happening. In fact, they're not going to happen until October of 2024. So they've put the consequences of default on hold. but they will kick back in someday. So default damages credit rating, collection fees are added to the loan, making it more expensive. Federal tax refunds can be taken and sent to the student loan company to pay off the loan balance, and they'll just keep getting taken until the loan balance is paid off. Same with wages. Employers can be contacted and told to garnish wages from paychecks so they can be sent and applied to the student loan instead. And then for borrowers to default on their student loans, they also can't get future financial aid. So all these things are on hold right now, but they'll come back in play. People shouldn't want to default. If they are in default right now, though, there's a unique opportunity to get out of default that isn't usually there. Usually to get out of default, it requires at least 9 monthly payments with the collection agency before you can get the loan returned to good standing. Right now, borrowers can just call collection agencies and say, I'd like to get out of default. I'd like a fresh start. And they call it the Fresh Start program. And really, it's just a phone call to say you went out of default. The collection agency might have them sign something, but they get returned to good standing really easily. So this is only going on for the next year, and borrowers need to take advantage before these consequences kick back in. So things to take away from this, when in doubt, IDR, income-driven repayment. It's a good program. And I know for some borrowers, it's still not going to work because they have higher incomes. That's where some of those other options are there to fall back on, the non-income based plans. But for most people, IDR is going to be good. And it's going to tailor it to them. Under an IDR plan, some borrowers will get payments as low as $0 a month and still have those count as qualifying payments, both towards IDR and PSLF. And right now, the maximum repayment period is 20 to 25 years, but we know 10 years is coming for some borrowers. And the application for the new SAVE plan is supposed to be available this summer. I don't have a date or anything like that, but it's coming. If you want to get a head start, you can enroll in Repay Now, and then you'll automatically be transferred to SAVE when it's available. Other big things. So just like last week, the Department of Education said they have all this more student loan forgiveness coming. And this is what they were talking about. There's these one-time IDR account adjustments that are happening behind the scenes. Borrowers don't typically have to apply for this. The Department of Education is just going to do a recount themselves. So they'll receive credit for past payments made that would otherwise not qualify for IDR or PSLF. So payments made under the standard plan or under the extended plan or partial payments. They will count those as qualifying payments. And so some borrowers will find that they're already at year 20 for an IDR plan. Even if they're not on IDR, they're at year 20 and their loan will just be forgiven. Others will be told they're 15 years in, and they only have 5 years left. For PSLF, they'll redo the calculations. If somebody has a PSLF application documenting employment and say, we went back and looked at all your payment history, and we've decided you do already have your 10 years in. So some borrowers are going to be seeing this automatic forgiveness. They're just starting it this month, and they're going to go all the way until 2024 with this. The only borrowers who have to take a step to take advantage of this, other borrowers are just going to happen automatically. But for Fell and Perkins and HEAL loan borrowers, they have to consolidate into the direct loan program by the end of this year. And then they also will have these account adjustments happen as long as they consolidate into the direct loan program after this year. They're going to do this for deferments and forbearances as well, because the Department of Education has kind of taken the stance that servicers were placing borrowers into deferment and especially forbearance when they really should have done an IDR plan instead. So they're going to count certain periods of forbearance and deferment as qualifying payments. This is in the past. It may not be a thing going forward. There's going to be some cases going forward where they'll count deferments, but not all. But right now, as part of these one-time account adjustments, they are going to count them as qualifying payments. And many people are going to see that payment count advance. They'll see immediate forgiveness for PSLF and IDR. They just have to watch their mail, their email. They'll be getting notified by the Department of Education that this is happening to their account. Again, the only people who have to take steps to make it happen are non-direct loan borrowers. They have to consolidate into the direct loan program. I think this is it. Oh, 5 steps to remember, and then, yeah, we wrap up. So things to remember, repayment plan based on budget and goals. So select a repayment plan that works for you. Borrowers can change repayment plans at any time. They're not locked into one repayment plan and stuck forever. They can postpone payments. They can look into loan forgiveness programs. And as I go over all this information, it's not your job to decide what's the best plan. That's the student loan servicer's job. So borrowers just should call in and say, hey, I'm stuck. This is my situation. Help me. And that really is it.
And we want to take this time to thank everyone for the questions and also thank Hannah for joining us today. A great conversation, a great presentation. We know this is a very complex topic, And if you have additional questions that come through, just send it to one of your contacts at Health Action Council, and we will be able to connect you with a professional at Ascendium to help you out. We will be putting up SHRM, HRCI, and subs credit polls. So for those that need credit, please stay on and make sure you respond to the poll. I want to remind everyone that members of Health Action Council will be able to find a copy of slides and the recording in the member center on the website by the end of day Monday. If you have additional questions come to mind as we close the webinar, please email them to Corey Jones, our digital communications coordinator, and he can be reached at cjones@healthactioncouncil.org. Finally, I want to remind everyone that our next educational session is the burden of obesity, and that is on August the 8th. We'll be looking at obesity as a root cause for many chronic conditions and look at a few approaches on how to combat the issue to help lower healthcare costs and increase the health of your staff. Again, thank you today for joining, and we hope to see you soon.